Hello and welcome to episode 12 of Macro Mondays. We have lots of content to cover today. For some reason, we're talking about Buffett again. I don't think in my history of following investing and following markets that I've ever kind of had to look at the activity of Buffett so much before in my life. But the recent Q3 highlights that I'd like to cover today would be that he has further reduced his Apple and Bank of America positions. Their revenue is actually slightly down year over year, but not much. It's quite insignificant. But I would say the following 2 points are a little bit more significant, to say the least, and that's that they have stopped buying back their own shares. So what does that typically mean? That typically means that they actually believe that their share price is higher than the fair value of their company. That's their view. If they thought that they were getting a good deal, then they'd be continuously buying shares back and reducing the amount of outstanding shares, which would increase the stake of all of their shareholders. So right now they believe that the price that the market is putting on Berkshire is actually slightly too high and it's stopping them from doing buybacks. And lastly, but not least, the cash pile has now grown to 325 billion. That's the equivalent of the 28th largest company in the world, just their cash pile. So to say the least is that Buffett is concerned and reducing his exposure and getting ready to be able to allocate some resources when the time feels right. The slight reduction in revenue year over year is an interesting sign, but it isn't material. I would say what is more material is how aggressively he's dumping the Apple and Bank of America positions and the freezing of buybacks. So that's pretty important. Now this chart here, which is from currentmarketvaluation.com, it's slightly out of date, but I was looking at a real-time one. We're still at about the 200% mark, but you can see here where the market topped was at 209% of GDP. And you can see also that that means that the market is extremely overvalued from the Buffett indicator perspective. Historically speaking, now the most expensive the market has ever been. So this kind of goes hand in hand with Buffett's actions and the Buffett indicator. So Buffett's actions are that they have stopped buybacks and they're reducing some key positions, Apple and Bank of America most notably. In the meantime, the Buffett indicator is at all-time highs. So these things are definitely interesting to observe. Perhaps there's no action to take from it. The two combined make me a little bit nervous around the indexes and just the general valuations of the market right now. So definitely something that I look out for and I've been watching. So Nvidia has now been added to the Dow Jones Industrial Average. And I kind of get a sense that this whole subject or all these subjects that we have in the docket today are quite telling of the times. So now we have in this next subject, Nvidia added to the Dow Jones Industrial Average and replacing Intel. That's quite timely and kind of telling of the environment we're in. We're replacing Intel, a previously dominant player in this space, and we replaced it with Nvidia, which makes total sense from a Dow Jones Industrial Average perspective. You know, these are supposed to hold the 30 most discussed and largest companies in the world, or specifically in the US. And it definitely fits the criteria and is definitely outperforming Intel. So it makes sense that it's been replaced. One thing that I've found quite interesting when looking at market cycles is that the Dow Jones becomes historically very volatile at the end of market cycles. And I wonder if it has anything to do with when specific companies are being added to the index. Now, this isn't going to be a major position in the index initially. So what we are seeing is that it's not, a top 1 or 2 position. It's quite low on the weightings. So it's not like it's going to be monopolizing the market cap of the Dow Jones Industrial Average, but it's going to slowly be increased and become a bigger part of this index. So something quite interesting to observe and definitely marks, I guess, a moment for Nvidia and AI in this cycle as we've had this company added to the index. To move on to a connected subject, Nvidia's third largest customer since the top that it reached in kind of mid-March to today has lost 78% of its value. It is their third largest customer, Nvidia's third largest customer. It's Super Microcomputer Inc., SMCI. And what has happened, essentially their auditor is refusing to work with them anymore. So Ernst Young, EY, stopped working with them. And that has created a humongous consequence for the company. It meant that the company was unable to file certain returns in a timely manner. And it has had a cascading effect, which has dramatically affected the stock price. And we're talking 78% down from the highs. And just over the last week, I think it was down about 38 to 40%, potentially even more. But What does this say? I think it's a sign of the times. Typically, when you have a great cycle and you have great appreciation in asset prices, you get to have creative accounting starts playing into the market as the expectations of the market grow and the companies are striving to continue their strong streak of performance and want to keep eking out growth. Inevitably in these cycles, what then happens is because of the incentives which show this industry growing and continuing to grow earnings and revenue, then accountants and different players in the game start to become more and more creative around how they do their accounting. And this has happened many times in many cycles prior. And what has happened is essentially their accounting practices are not up to standard, and their auditor at this point is now refusing to work with them. This isn't the only company where we have been kind of scratching our heads around the accounting practices. This has also happened with Nvidia, with Microsoft, with other companies, perhaps not at this scale, but I think it's when you're investing in, for example, a company, and then they are providing you revenue, it's kind of a circular environment for investments and assets that you're obtaining to then turn back into revenue, which improves kind of many of your business metrics. We're going to still find out what the full story is here, but I wouldn't be surprised if this is one of many in this cycle that have been extremely creative with their accounting. Okay, so what's going on with the job numbers? Last month, we had this blowout number where over 200,000 jobs were added to the payroll in just a month. 1 month later, we're down to 12,000. Bearing in mind, there are still going to be revisions for prior months, so that 200,000 number may come in a lot less. And because so many prior numbers have been revised down, you wonder, is this October number going to also be revised down, which could be a real catalyst for the market. The investor ecosystem has kind of pounded the table on the fact that as long as the labor market is good, we're happy to pay these high multiples for stocks. Well, what happens if that labor number and this job number goes negative after the revision? And we're obviously going to follow this through for the next couple of months as we go through to kind of the November number, the December number, and into the new year. Bearing in mind, from a cyclical perspective, a lot of those layoffs could come at the end of the year and early into 2025 as well. That's typically where we see a little bit more activity in regards to layoffs and changing of the dynamic within companies and making adjustments. The market didn't react too much to this. However, it's a pretty significant piece of information we should take on board for sure. Now the betting markets, speculation and traders. So over the weekend, essentially, or over the last kind of week or so, the betting market has changed dramatically on what the market participants believe the outcome would be. Essentially, people were believing that Trump was going to win significantly. And what happened was, of course, they would come in and bet that Trump would win, which reinforced this perception and these betting odds around Trump winning certain states, in this case Pennsylvania, but also the election at large. So what we've seen here is we've seen a reversal. Is that necessarily Trump has done something wrong, which would result in the probability of him winning dramatically changing? Perhaps, but also what plays a massive role in this is the market participants that have bet on this event. These is potentially also traders that are trading and have made a significant kind of gain because they bet early. Then they've got this huge win. They've got the probabilities in their favor from a market perspective. They're going to get paid good odds to cash out this bet. So traders are trading here, speculators are speculating, and the betting market is no way to predict an election, especially when many of the constituents in this betting market are not even from the US. So it's definitely not a vote in a traditional sense, like a poll. It is a vote of market participants predominantly out of the US betting on whether Trump would or would not win the election. Thank you once again for listening to another one of our Macro Mondays. We look forward to talking to you next time as we uncover more topical events in the world of macro markets and the economy at large. So have a great week and we'll speak to you soon. As always, this podcast is for information and entertainment purposes only. There are no buy, sell, or hold recommendations of any investment security in this podcast, and none of this is personalized financial advice.